We will be talking about solvency in financial statement analysis. First, let's define what is solvency and what is stability because these two terms are normally used interchangeably. When we refer to solvency, this is a company's ability to meet long-term demands. Okay, in some books they just say your ability or the company's ability to pay long-term liabilities. But take note that your long-term liabilities is just a component of long-term demands. When we say long-term demands, those things that you have to pay in the future, which may not be included in your financial statements. Stability, on the other hand, refers to a company's ability to operate on a going concern basis. Okay, so solvency has something to do with your ability to pay long-term demands, while stability has something to do with your operation, your ability to operate for a long period of time. Okay, so what are the common ratios for solvency? Okay, first you have your debt ratio, which is the favorite. Your debt ratio is computed by dividing your total liabilities by your total assets. Okay, equity ratio is the stockholders' equity divided by total assets, and you also have your debt to equity. Let's just choose a pen. Let's choose our favorite color, red. Okay, so if this is your total assets, you want to know how much of your total assets, okay, is funded or financed by your stockholders' equity, and how much of your total assets is financed by your liabilities. Liabilities plus equity will always be equal to your total assets. This is actually your debt ratio, and this one is your equity ratio. Okay, if we get the ratio of these two, liabilities divided by stockholders' equity, that's now your debt to equity ratio. Now, these ratios are known as complementary ratios, no? Because they always add up. They complete each other. Ayun. Okay, another way to compute for your debt ratio is 1 minus your equity ratio, while your equity ratio is computed as 1 minus your debt ratio. And this one you can divide your debt ratio by your equity ratio. Okay, now let's continue. Since they are complementary ratios, no, understanding one ratio is enough for us. What do I mean? For example, your debt ratio is 60%, okay? Automatically, this one is 40%. We already know what will happen to the other ratio by simply analyzing one of the ratios. So if we expect this to go up, let's say from 60 it went up to 80%, since their total is always equal to 1, we expect that this one will go down to 20%. The total is always 100%. Why? Because total assets will always be equal to your total liabilities plus capital or stockholders' equity. Now, for our discussion, we will just focus on your debt ratio. Okay, so when we talk about debt ratio, what do you want? Do you want it to be higher or do you want it to be lower? This is a common question. No? For us to understand okay, how to use debt ratio in decision making, we have to first understand the basic concepts of leverage, weighted average cost of capital, and the value of the firm. Starting with leverage. In our example, we will be using your financial leverage because there are different kinds. Now you have the financial leverage, Okay, you have your operating leverage and your total leverage. To simplify, okay, the concept of leverage, we'll just use financial leverage. So let's have a story. Assuming that you want to start a business, and based on your study, okay, the initial capitalization of your business is 10,000 pesos. So you told your, let's say, your partner, or you told your mom that you were going to start a business using 10,000 pesos. And your mom, okay, suggested that why don't you just use 5,000 pesos, okay? So that you have spare of 5,000 pesos just in case your business will not be successful. So you insisted that, well, I need at least 10,000 pesos for my business. So your mother made an offer. Okay, if you say so, what if you start your business with a capital of 5,000 pesos and then I will lend you another 5,000 pesos. So now you have a total amount of 10,000 pesos. So now you have two options. You can start a business of 10,000 or you can share the risk with your mother, no? 50-50. 5% coming from you and 5% coming from your mother. So let's assume that you agreed, no? Okay. Okay, sige. Okay. Your offer is good. I think I'm going to take that. So your mom told you, oh, I'm so proud of you. Okay, at a very young age, you are applying basic concepts, no, that you are learning from school. So I hope you're going to understand if I'm also going to charge you an interest of 10% for every period. Now let's try to evaluate which is better, okay, from these options. Let's assume that all costs are variable. Now when we say variable, okay, your cost of sales and operating expenses, okay, will move in the same percentage or will have a constant percentage, okay, um, of your sales. Ayun. So for cost of sales, it will be 60%. For operating expense, it will be 20%. Okay, so let's assume that these are all variable costs. Okay, except for our interest expense, which will be fixed. Okay, so given a fixed cost of 10% of 5,000, let's compute that. 10% of 5,000, that will be 500 pesos. So now you will say, if I haven't taken the offer of my mother, my net income should have been 2,000. But because of this interest, my net income is only 1,500. So are we saying that this option is better than B? Let's try to analyze further. Okay, this option, you have a net income of 2,000 when your capital is 10,000. So to compute for your, let's say, return on investment or return on capital, we divide 2,000 by 10,000 as your capital. You now have how much? 20%. While for option B, okay, you have a net income of 1,500. Okay, 1,500. We divide that by your capital, which is only 5,000. Now you have a return on investment of 30%. This is the basic concept of leverage. Maximizing returns, okay, by using your fixed cost. This is called financial leverage because your fixed cost came from financing. Okay, now let's continue. Assuming you were able to, let's say, double your operations because it's successful now. From 10,000, your sales became 20,000. Let's try to analyze option A. If we double our operations. So assuming this is a good year for us, your sales from 10,000, it went up to 20,000. This is an increase of what? 100%, which means it's times 2, right? So you were able to double your operations. And since your costs are variable, they are also doubled. And since you have no fixed cost, your net income also doubled. If you compute for your return on investment for year 1 and year 2, that's net income divided by your capital. This one is 20%. And for the second period, 4,000, no, 4,000 divided by 10,000, that's now 40%. So your return on investment also doubled. Now let's try to analyze option B. Okay, in option B, your return on investment was initially 30%. That's 1,500 divided by 5,000. 30% is hard to use the mouse. Now for year 2, if you compute for your return on investment, you divide 3,500 by 5,000, you will get 70%. Ta-da! This is the second feature of a successful leverage. Okay, an increase in your operation will result to a higher increase in your return on investment. If you notice, your sales doubled, but your return on investment is more than double. Okay. Now, let's put this aside and let's talk about your cost of capital. Okay. Let's try to understand your cost of capital as how much you are paying every time you use other people's money. Okay. So if we are, let's say, mm, computing, no, let's not use the word computing. If we are using yan, the money from the investors, which is your equity, yan, we pay them in terms of dividends, okay, and that cost will become part of our, I'm sorry, and let's try to erase that. There you go. Ayaw po niyang mabura. Anyway, let's continue. Okay, that will now be considered as your cost of equity. Yan. And your debtors, okay, every time you use their money, you're going to pay them interest. And that interest is now part of your cost of debt. Yan. If you put them together, you now have your cost of capital. Now, that is assuming that these are the only sources of your capital, equity and debt. No? As simple as that. Now, in other books, you have your cost of preferred shares, cost of bonds, cost of retained earnings, and cost of common stocks. But for the sake of our discussion, just to simplify, we're going to assume that there are just two sources of debt, of capital. You have your cost of equity and you have your cost of debt. Mhm. Let's continue. Assuming, okay, assuming that these are the weights. Okay, these are the weights of your capital, and this is the actual cost of your capital. Your weighted average cost of capital is 10%. Anyway, let's add some more data. Let's have a story. Assuming assuming you saw project A, and the cost of project A is 100,000, okay? And the internal rate of return, okay? Let's just use this term, internal rate of return, or just a measure of return. No? Ayan. ROI will do. Pero soon we'll have a separate discussion for this. Your IRR of 6% and your cost of debt of 5%. Is this a good investment? Assuming that as of the present, the only source of financing is liability and the cost is 5%. So you're going to borrow at 5%, invest that in project A, and you're going to earn 6%. Initially, this is favorable because you will be earning more than what you will be spending. Now let's have another project. Assuming we have project B. After some time, you saw project B, they have the same cost. This time the return is 14%. And as of this moment, the available source of financing is equity. And the cost of equity is 15%. Are you going to take this investment? Okay. You're going to have a return of 14% and you're going to pay the investors 15%. Initially, this will be rejected. If you try to look at what happened, no, you ended up accepting a project with an internal rate of return of 6% and rejecting a project with an internal rate of return of 14%. This is the reason why we shouldn't be using the individual cost of equity or cost of debt when it comes to decision making. Instead, we should be using the weighted average cost of capital. Imagine, instead of using 5%, what if you used 10%? Compare that with 6%. Are you going to accept this project? Okay, the answer will be no. Okay, this one will be rejected. And if you use 10% to evaluate this project, compare that with 14%. Are you going to accept this project? The answer is yes. By using the weighted average cost of capital, you ended up accepting a project that has a higher return. Okay. Now, assuming there are more assets to choose from, and you saw the following assets. Asset 1, 2, 3, 4, and 5, and they are ranked according to their, let's say, internal rate of return. Okay, the actual return of a project. Using our existing cost of capital or weighted average cost of capital, which was computed earlier, okay, we can say that asset 1 and 2 are acceptable because the IRR is higher than your cost of capital. But since we now know that the cost of debt is cheaper than the cost of equity, okay, and since we are all humans, by nature we are greedy, okay, we'd like to have more assets or more investments that are acceptable, okay. How do we do that? Okay, if we cannot increase the return, we are going to reduce the cost, okay, by playing with the mix. So now, assuming we were able to increase the weights, no, of your liabilities to 60% and your equity to 40%, okay, this means that your source of financing is geared towards debt financing, okay, you will now have a cost of capital of 9%. With 9%, asset number 3 is now acceptable. So now you have three acceptable projects. Let's try to exaggerate and let's assume that you can still borrow money. Okay? Ayan. And you were able to increase the weight, okay, from 60 to 70%. Ayan. So what will happen? Your cost of capital will now be 8%. This one will also be acceptable. And utang pa more. Ayan. More debt, 80%. So your equity is now 20%. A cost of capital of 7%. Now 7.10% is now acceptable. Okay. So if you try to put that together, okay, we can now say that if this is your debt ratio, okay, the higher the debt ratio, the lower will be the weighted average cost of capital. Okay, we'll go back to this soon. Ayan. Let's talk about the value of the firm. Okay, if the no, let's not use financial concepts. Instead, let's just use economics. Ayan. Do you still remember the concept of ayan, demand and supply? There you go. Okay, this one is also applicable, okay, in valuation of firms or valuation of their stocks. Let's say a company is performing well. And what will happen? There will be a shift in the demand for that company. Investors will want to invest in that company. Because of that, there will be a shift in the demand. This one is your equilibrium price or the fair market value. If there is a shift in the demand, we expect that the price of this commodity or this stock will also go up. Ayan. So you see the basic law of supply and demand, okay, can now be a basis for valuing the firm. Now let's just stick to that. Although there are more movements and shifts, okay, I just want you to focus on the change in the demand. Going back to our slide, okay, if a company was able to invest in assets that are earning more than its cost of capital, definitely it will have a higher earning potential. So the value of the firm will increase. How do we draw the value of the firm? Oh no, this is the standard deviation. Let's try to erase that. The symbol for the value of the firm actually looks like an ovary. Ayan. Let's choose a color. Something like that. Okay. The lower weighted average cost of capital, okay, more projects, no, more projects available for the firm, higher demand for the firm, higher value for the company. Okay, now take note, okay, that this is only true up to a certain point because the higher the risk, the higher the return. If that is applicable to us, okay, this is also applicable, okay, to our owners and to our creditors. Okay, at some point, you cannot just keep on increasing the debt ratio. At some point, your creditors will demand a higher return, even the owners. So you will expect that your weighted average cost of capital will increase. Okay. Now at this point where the weighted average cost of capital will increase, okay, let's just say this is the debt ratio. And we don't know what is that debt ratio. Okay, at this point, this is the point where the value of the firm is at its highest. And beyond that, we expect that the value of the firm will also go down. Okay, and now, what's the application of this? This is actually your optimum capital structure. And this is the best debt ratio for us. Okay, let's try to review. Higher debt ratio, lower weighted average cost of capital only up to a certain point. Okay, at some point, it will increase because the company will be too risky. And because of that, if this will increase, okay, there will be less projects available for the company and lower demand for the company, and that will reduce to lower share value. Okay, that's the value of the firm. So now let's go back to our basic question. Our earlier question is, do we really want a higher debt ratio or a lower debt ratio? Now let's try to draw that again. Okay, as much as possible, you want a low weighted average cost of capital because lower cost of capital will mean more favorable projects for us. But your debt ratio, no, no, ayan. Your debt ratio will dictate na, well, it's impossible for us to have a zero, no, or a weighted average cost of capital that is close to zero because a higher debt ratio will mean higher risk, okay, for the company. And higher risk will mean higher returns for our investors and creditors. They will demand higher interests and higher dividends. And this movement will be coupled by this movement of the value of the firm. Or let's try to draw that. Ayun. Stock price, which is dependent on the interrelationship of your demand and supply. In this case, while the weighted average cost of capital is going down, more projects available to the firm, higher profits, okay, higher demand for the company, higher value. Beyond this point, and higher debt ratio, higher weighted average cost of capital, lower value of the firm. So do you want a higher debt ratio? If this is your debt ratio, let's say this is debt ratio number 1, this is your weighted average cost of capital, and that's the value of the firm. Is this favorable? As of this point, we can't say. Assuming that you made a decision, no? Made an investment, and it resulted to a lower weighted average cost of capital. Maybe that is through debt financing. Okay, let's call that debt ratio number 2. Okay, so you finance a project through debt. It resulted to a lower weighted average cost of capital, thus increasing the value of the firm. Is that favorable? The answer is yes. Let's assume that you applied for additional loans or you issued more bonds to support your investments. Ayan. Let's call this debt ratio number 3. Is this favorable? Yes, because it resulted to a lower weighted average cost of capital and higher value for the firm or higher stock price. Take note, the primary objective of financial management is to maximize shareholders' wealth, and any decision resulting to a higher market price is a good decision. Assuming this is debt ratio number 4, a result of another decision. Is that favorable? The answer is yes. We are close. Ayan. To the optimum capital structure. Let's assume and let's just exaggerate, no, that you applied for additional loan. So your debt ratio increased, which resulted to an increase in your weighted average cost of capital from this point to this point. Is this favorable? The answer is no. Why? Because your weighted average cost of capital is higher, and we expect that the value of the firm will be lower. So next time you needed money, are you going to increase your debt ratio or are you going to finance that using debt? The answer is no. So what are you going to do? Since you need money, you're not going to pay your debt. Instead, okay, going back to the concept of debt ratio and equity ratio, since they are complementary, next time you needed money, don't use your debt. Instead, go for equity financing. Because if you issue stocks, okay, or if your capital will increase, we expect that your debt ratio will go down. And by decreasing your debt ratio from this point, okay, might result to a lower weighted average cost of capital, which may result to a higher share value for us. So the question on whether you want your debt ratio to be higher or lower, it really depends. You have to be cautious about the use of this ratio, no? In some books, they will say a lower debt ratio will be better because lower debt ratio will mean there will be lower risk in the future. And lower risk will mean a more stable company. Okay, so you will be more stable and that will be more favorable for us. But take note, the lower the risk, the lower the return. So we still have to analyze and consider the trade-off between the two. Okay, so that's it for solvency, and thank you.